A very warm welcome to our listeners, both those that are on screen today, as well as people that will be listening to this through a tape broadcast. I want to give a special shout out to the Brandis Center, which is part of the Rady School of Management at the University of California, San Diego, as well as Bob Schmidt, who coordinates these types of sessions. We have three panelists. Our topic is public equity structure. Maybe a better way to say it is imagine that you were working with a institutional fund between 50 million and 20 billion, and you were the head of public equity. What kinds of things would you be thinking about as you structure your portfolio to have a high confidence of achieving your objectives? I'm aware that our audience has a pretty broad wingspan in terms of investment experience and acumen. That said, we're speaking as though we were talking to an investment committee who was responsible for making these types of decisions. Public equity structure, is it a timely topic? I ran it by a few of my friends and they said, absolutely not. You know, all the juices and the alternatives, particularly private investments. I think it's an extremely timely topic for two reasons. About a decade ago, I had a friend who was in the ski business, and he told me 80% of the sales are in snowboards. Yet when I looked out on the slopes, most people were still using skis. The relevance there is that public equity remains the largest component of most institutional portfolios. So it's overweighted, but in my view, underemphasized. The second reason is one that embarrasses some of us that have been in the industry for quite a while. There have been some key tenets that we learned and embraced back in the 90s. Uh, things like Gary Brenson and Barton Biggs telling us that we should invest overseas outside of the US. Fama and French and other academics gave us an elegant notion of a value premium. The Ibbotson studies made it pretty clear that there was a small cap premium. Well, it's not a problem when your key investment beliefs are out of sync for a couple of years, but 16 years, when you look over that period starting in 2009, the Russell 1000 beat EFA by 800 basis points annualized. The Russell 1000 growth beat the Russell 1000 value by 630 basis points annualized. The Russell 1000 has beaten the Russell 2000, the large cap versus small cap comparison, by 330 basis points a year. And just imagine if you were back in 2009 and you were trying to figure out your allocation and forecasting between the Russell 1000 growth and emerging markets. This is probably the largest divergence. There's been almost a 15% annualized difference, 17.6 versus 3% over the next 15 years. We've got a strong panel. I'm Barclay Douglas. I run a fairly small institutional investment consulting firm. Since I've been in the business, Russell Investments has been kind of the gold standard in institutional investing. Rachel Carroll now heads the consulting group for U.S. clients. She joined Russell back in 1993. Trevor Graham works at TIFF, a terrifically strong outsourced chief investment officer, what some of you may refer to as an OCIO. They cater to not-for-profit clients. He is the head of public equity there. He started his career with Lehman in investment banking, moved to private equity, was a key member of the investment staff at the Museum of Modern Art, and then the New York Presbyterian Hospital. Trevor joined TIFF 12 years ago. And finally, Aswath Damodaran, always humble. He describes himself as a teacher and a dabbler in finance. Also, he describes himself as a disruptor. I'm pretty familiar with his work, and he's kind of the king of finding kings that don't have clothes on. In fact, he is a professor at Stern School of Business in NYU. He is frequently referred to as the Dean of Valuation. He's written 12 books on the investment world and has a website and YouTubes that, in my opinion, you should all frequent. They're terrific. Earlier, I alluded to the notion that thinking about equity strategy frequently emphasizes the recent past, post the great financial crisis. As a spoiler alert, a common theme we'll be wrestling with here. To what extent do these recent dynamics are they cyclical or more structural in nature? We're going to cover 6 topics on this session. One has to do with allocations by geography. Another big one, the active passive debate. Another has to do with structuring the portfolio using traditional style boxes. We're going to talk about, for those who use active management, manager selection criteria. And then a few thoughts on, has this world changed? Have there been developments over the last 5, 10, 15 years that have changed the way the markets work? But our very first topic is going to be a bottom line view from each of the panelists. Trevor, you actually have a portfolio in place. I'll ask if you could describe what that structure looks like.
Sure, no problem. And thanks to everyone for joining. So I'll just explain what we do at TIFF at a high level in public equities. We use a mix of active and passive, but it's primarily an actively managed portfolio, typically 85 to 90% of it's active. We're very aware of the challenges in this part of the market with active investing and how hard it is to outperform. And so we use a couple of techniques to basically try to improve our odds. And as a result, our portfolio, I think, looks very different from a typical collection of institutional funds. So basically, we try to outperform using a combination of strategies. On manager selection, it's a combination of either highly concentrated portfolios, so something like 5 to 10 stocks. We use combination of country and sector specialists, especially in areas where we think basically being a resident expert pays off, gives people a distinctive competitive advantage. And even outside of those areas where we do still use generalists, we lean hard into this notion of finding some sort of competitive advantage in the investments process. And so even with the more generalist type managers that we use, they usually have some sort of either information, scale, or process advantage. And so that's how we try to outperform on the manager side. There are a couple of structural issues we use at the portfolio level also. Most of our managers are subject to performance fees for outperforming a benchmark. And the management fees on most of our relationships are very low. In some cases, they're actually zero. And so we're trying to basically motivate people to outperform, not to gather assets. We do a lot of investing with managers early. Something like 20 to 25% of our current portfolio is in the hands of partners where TIFF was either the first institutional investor or the first investor, period. And then one last issue we try to do on the structural side is that we place a very big emphasis on getting the underlying holdings, especially for the traditional fundamental managers. And we do a fair amount of risk management in-house. So for example, if we find that we're overweight a certain sector or a certain country in an unintended way, it's just a sum total of what our various managers are doing, we will take action ourselves to basically manage the risk. So we use a combination of futures, ETFs, things like that. And I think a lot of so-called manager selection people oftentimes don't have futures trading capabilities. And that really helps us. It's one of the things that basically enables us to have some of these high tracking error, but high alpha investments.
Thanks, Trevor. Rachel and Aswath, you advise or teach on the topic of public equity structure. Describe for us some of the basic tenets that support your approach. Rachel, start with you.
Sure. So as you mentioned, I oversee our U.S. consulting business. We have a variety of clients that we work with across Russell Investments, but within our consulting group, I would say our client base leans heavily toward corporate plans, typically very large corporate plans. And Barclay, I would challenge one thing you said at the beginning about public equity being kind of the largest portion of everybody's portfolios. For a lot of clients that we work with, that isn't necessarily the case. A lot of these are very well funded and significantly de-risked investors, which just by the nature of being a shrinking proportion of the portfolio has had some impacts on how these investors are approaching their public equity structure. I would say in general, Russell does believe in kind of the old tenets of the value proposition, the small cap, that small cap wins over time. We can get into detail on that because you're right, there is a very long tail to some of the cyclical things that we have seen happening, and you have to be very patient. And the reality is, for a lot of corporate investors that are facing investment committees, they don't have the timeline or appetite that might be necessary to wait for a value tilt to pay off. So we are flexible in how we approach the clients that we work with. Each client is unique. We're thinking about their circumstances, how this public equity plays into their overall plan. And that really helps drive the advice, the really customized advice that goes to each client. Underlying all of that, though, is deep and robust manager research, where we are really striving to identify those managers that do have a unique process that will pay off over the long run. Trevor, your comment on holdings is really interesting. We absolutely lean into doing analysis of holdings, of how managers are trading and changing their portfolios over time, so we can really get an understanding of what their investment philosophy is and whether or not they have a repeatable idea that will pay off in the long run.
Rachel, remind me to come back to you later on. You were talking about corporate plans or de-risking. Many of them I know are going much more passive. The
Yeah.
question I'll have for you later is an indexed approach the low risk option, which many people think, and I'm interested in your opinions. Let's go to Aswath. Your thoughts, what are the key tenets?
I teach valuation in corporate finance, but I also teach an investment philosophies class, and I pretty much break every rule of what I tell other people to do in that class. Now, I start with the presumption that the way you check to see if your portfolio is reasonably diversified is to draw a pie chart of your holdings, geographically, sector-wise, and compare to the pie chart, market cap-wise, of what the world looks like. I just did this for the start of 2025. The world looks very US-centric right now. For US equities collectively account for almost half of global market cap. In terms of sector, globally, technology is 21%, and then you have the rest coming through. And if you have a portfolio that deviates from that pie, it's not bad, but you better have a really good reason for what you're doing. Whether it's a sector or a geography, you got to say, this is why I'm doing what I'm doing. And I'll draw on what Trevor and Rachel has said. Unless you can show me what your competitive edge is for having that skew, I'm going to be skeptical. You started with Farmer French, and it's funny that when I was TA for Ken French when he was in the early 1980s, because he used to leave Chicago in the winter and come to LA partly to flee the weather and partly because his daughter had a restaurant in LA and he wanted to be in LA. So I was his TA for 2 years. And as those of you know, Gene, he is the firmest believer in efficient markets that you can ever run into. So the Farmer French paper, which is the basis of so much active investing, Gene Farmer and Ken French specifically state that they did not find a premium for value stocks. What they found was that risk and return models in finance didn't explain what they found in the. So their argument is there's something wrong with our risk and return models, not that you can beat the market. Of course, people took what they wanted out of that. And I've always been skeptical about factor tilts and anything that is too easy that everybody can do. My argument is, why would I pay you to do that for me? That said, though, I do manage money for one client. And that client is very, very forgiving. It's myself. And with my own investing, I am an active investor. But I tell people I'm an active investor because I enjoy the process of active investing. In fact, one of the tests I ask people to go through is, let's say you get to the age of 85, you're on your deathbed, and your best friend, I don't know why he was your best friend to begin with, because he comes to your deathbed and says, look, I've chronicled your returns over the last 60 years with your active investing and compared it to what you could have made if you'd put your money in index funds. and you've underperformed by 50 basis points. And the question I ask is, would you be okay if that happened? And my answer is absolutely. I don't invest to beat the market. If I beat the market, I think of it as icing on the cake. And the more endowments recognize that reality, I know you can't officially say that. I think the healthier this discussion becomes. Because when people believe that they can beat the market, they feel they're entitled. That's when it leads to really bad investment practices, because then you get mad at the market, you double down, you do things that actually hurt you. So I invest because I enjoy the process. I try to minimize the damage I can do to myself. I don't concentrate my portfolio. I don't make big bets that exceed a certain percentage. I follow the old Hippocratic oath, do no harm. If, as active investors, I think we need to follow that precept. And I would argue that, if you follow that precept, you can try things as an active investor, but you don't risk the kind of damage that becoming overly ambitious and trying to beat the market by 5 or 6%. I know I've gone on long enough, but one reason I'm glad I don't work at an endowment or at a fund is I find sometimes the starting point is unrealistic. People expect to make returns that they really cannot expect to make. They also put in constraints and expect those constraints to have no costs. I mean, I don't work officially with the NYU endowment, but if you're a university endowment, I have sympathy for you, because they keep adding constraints. You can't do this, you can't do this. And by the way, make sure it doesn't hurt my returns. I think, the first step in this process is that investment funds need to be realistic about what they can do and accept that when they put in constraints, no matter how well intentioned, it will cost them.
Thanks so much. I have many questions that I'll come back to later on. We want to move to the second topic, which has to do with geographic allocation. So many funds are broken out with a U.S. component, a developed non-U.S. component, and an emerging market component. Some have global equity managers. The returns between these different geographic locales have been so different. A lot of people, and I'll go to Trevor on this one, a lot of people benchmark all public equity against the global index, our ACWI. Does that make sense? Secondly, how do you think about, to all of you, to think about geographic allocation? Is it part of the way you think about structure? Trevor, on particular the global equity mandate, I had somebody ask me the other day, given the huge difference between US and non-US, why do you even combine them in the same category?
So I'll cover this in a couple different ways. Number one, we are subject to some kind of benchmark, right? Because we work for third parties, and they have a fiduciary duty to, from time to time, evaluate how their service provider is doing. And so at the end of the day, there is a benchmark, and people are going to compare how we do relative to that index. And I think they should. I think that's a healthy part of the process. And the index that we most commonly use is the MSCI All Country World. And so we tend to run our portfolios with a geographic allocation that's roughly similar to that index, mostly because we actually think that making geographic calls is very hard. As you know, I spend a lot of time evaluating active managers, and I've seen in my entire career, I don't think I've ever seen evidence of someone who's really good at making these geographic calls. And so we tend to not do it ourselves. And the portfolio we run tends to have something in the neighborhood of a benchmark weight on geography. And I really think it's dangerous for example, like the US is very popular right now. The US has led the way the last 15 years. And very often from clients and prospects, I get a question, the words are a little different, but very often the question is basically, why do you diversify at all? And I think it's easy to forget that no geography carries the day forever. In fact, one of the best macro strategists that we follow, and we actually read their research pretty closely, they make the argument that the last 15 years has been the best 15-year period for US equities ever. And if you look at the long-term history, the geographic diversification really pays off. And it's amazing. People forget it. But the prior decade for this 15-year window was almost exactly the opposite. The US underperformed the rest of the world by between 3 and 4% a year in the 2000s. And I can remember back then, everyone was super excited about emerging markets. Now I run into people who say that they don't think emerging market investing is worthwhile at all. And my point is simply that these phases of leadership change. I think it's really hard to predict. And at least for us, we lean very hard into idiosyncratic risk, meaning security selection. We do some market calls from time to time, but it's only when we feel like we've found a really great opportunity. And we're very careful about when we do it and how we size it.
Rachel?
Yeah, interesting, Trevor. I'm finding I feel more and more aligned with your thinking. I would say in general, most of our clients also take kind of a market weight approach when they're thinking about allocating between US and non-US. The one exception there, and this goes back to my earlier comment about working with many plans that are significantly de-risked. There are a number of organizations that in that context, as that return-seeking portfolio has become smaller and smaller, have made the decision to only invest in ACWI, either through a global manager or through just passive exposure to that ACWI index. That really is coming from a mindset of trying to simplify the portfolio more so than a call on US versus non-US. But Trevor, I think your point is spot on, and I think it's a point we're going to hear reiterated throughout the day, which is it's really easy when you're in a moment in time when there's a big divergence happening either between sectors or styles or geographies to think that the world has changed and we're in a new paradigm, and going forward it's always going to be the US, and the US is always going to outperform by the large swaths that Barclay was talking about at the very beginning. I think that's a bit of a trap, and feels like the minute you start to think that, oh, this time is different, is the minute that you are shown that it is not. So that market weight, I think, is the most rational approach. And again, I can't remember who exactly said this, but yeah, the clients we work with are overseen by investment committees. Those investment committees are fiduciaries. We are also a fiduciary to those clients. And there is an evaluation period that has to be taken into consideration. They are, regardless of whether or not the managers you're using are benchmark agnostic, the committee is being measuring results against some kind of a benchmark, and taking big bets against that benchmark can make you look like a rock star, or it can make you look quite foolish, depending on how the market moves.
Yeah, you're referring to the embarrassment factor.
Well, and for a lot of the organizations that we're working with, because they are large and well known, it's headline risk. There's headline risk associated with it as well.
Aswath, any comments on the geographic allocations?
I do actually. I think that one of the things I find troubling in investing in general is how much we forget statistics. I still remember standard errors. My first statistics class, I was, remember the standard error. Let me take, for instance, two indices, the S&P 500 and the MSCI Global. The conventional wisdom is the S&P 500 outperformed the global. It's true. In the last 15 years, the S&P 500 has earned about 1.7% more on an annual basis than which is substantial. But the standard error in that difference is about 7%. Yeah. If this were a statistics class, I could not statistically reject the notion that there is no difference in returns between the S&P 500 and the rest of the world. That's what Trevor, I think, and Rachel are making as more generic points, is we think in chronological time. We think 20 years is a lot of time, but in stock market time, 20 years it's like 15 minutes in time. It's as if, I work with historical equity risk premium, which I'd never use in valuation, because it's estimated you need 250 years of continuous stock market history before you get an equity risk premium that is reliable enough that you can use it in valuation. So when you look at 15 years or 20 years, it's easy to then say, oh, you know what, US is going to win all the time. You know, that said, though, there's one other caveat I want to add here, which is the cost of not being globally diversified has decreased because US equities, as we call them, have become more global in their focus. I mean, take the S&P 500. You're buying 500 large US companies. But at the same time, they get about what the technology part of it gets about 60% of its revenues outside the US. You are getting a global bet through the S&P fund, especially with large cap US stocks, that kind of gives you that global exposure. Now, one final point, and I think this is worth keeping in mind as you look at the debate about global versus just the U.S. I think that for too long we've thought about companies in terms of incorporation. I'd love to see an index that is based on operations. I know it's going to be messier to create, but I'd love to see an index that says, let's look at the returns from looking at companies that have operations in the US, operations in India, operations in China. And right now, I think we're still stuck with where you're incorporated. Let's think of that company as a US company, an Indian company, or a Chinese company. So I think if you're not globally diversified, the pain is lower now than it might have been 30 or 40 years ago because the correlation across markets has become so much higher, especially during periods when you worry about correlation the most, which is crisis periods.
Great points. I'm not sure that the average investment committee member would suggest 20 years is like 15 minutes. Let's move to the next topic, which I think is the biggest one in this session, and it's active versus passive. I encounter it on a daily basis, clients wondering, what's our divergence factor? What's our tracking error? Should we be more passively oriented? And I'm going to begin by going to Aswath. Over the years, we've had some good conversations. I remember early on asking you, are the markets efficient? You said yes. Then I ask you, but you do a lot of valuation on your own, and I've seen you knock the pricing of individual companies. And you said, oh no, the market makes incredible mistakes, but nonetheless, it's still quite efficient. That befuddled me. Explain those kind of contrasting ideas.
You know, I think it's interesting because if you think of efficient markets as do markets make mistakes? Of course they're inefficient. They make all kinds of mistakes. But you think of market efficiency in a different way. Can people exploit these mistakes to make money? That's a much tougher test to meet. I mean, over the last 50 years in finance, we've uncovered all kinds of inefficiencies, at least on paper, right? You know, you make excess returns doing the, and then you look at people trying to earn excess returns, which are active investors, and say, where did all those excess returns go? There seems to be a slip between the cup and the lip. So when I say markets are efficient, that's a measure of efficiency I talk about, which is not whether they make mistakes, but whether you can exploit those mistakes to make money. And the truth is that ability to exploit mistakes has become less and less over time, partly because the investment world has become flatter. We share much of the same information. 40 years ago, if you're an investment banker, you had significant advantages over me as an individual investor. You had more powerful tools, you had more access to data. I'll wager today, at least in the US, that the difference between Fidelity and an investor sitting in Des Moines, Iowa, trying to pick stocks is marginal at best in terms of information access. Maybe there are benefits in terms of process, but I think the world is flattened out, which is part of the reason it gets more and more difficult to try to beat the market, which is ultimately my measure of market efficiency.
Excellent. I think it's commonly believed that some segments of the public equity market are harder to generate alpha in than others. I'll go to Trevor first. Do you believe that's the case? In other words, I know you're predominantly active, but do you believe it's the case that some segments, whether they're geographic or whether they're sector oriented, are harder to generate alpha, others are more conducive?
Bottom line, yes. I do. I think I mentioned at the outset that we, even though we believe in active and we utilize it quite a bit, we still have a healthy passive allocation. Probably won't surprise a lot of the people listening to know that in general, most of the time, that passive is heavily tilted toward large cap US, which we would argue is probably the hardest place within public equities to consistently outperform. One of the challenges of trying to basically beat the market, so to speak, in this area is there's this unfortunate trade-off, in my experience anyway, between the likelihood of outperformance and how much of the benchmark that the strategy covers. We tend to find there's a lot of alpha to be had in niche parts of the market. For example, biotech or certain other sectors or certain non-US markets. The challenge is that we have to, there's a limit to how much we can deploy in those areas without causing the tracking error to go through the roof and the portfolio construction to basically have a big bet on basically a different set of exposures than what the benchmark looks like. So no doubt some areas are easier than others. The problem is there's a limit sometimes to what you can do in those areas.
I'd say that the Russell philosophy is mostly aligned with that. When you look across the spectrum of our clients, most clients are using some portion of passive, most typically that passive. I would get a little more specific and say it's typically in the large cap core space. And oftentimes, if the portfolios are large enough, and the kind of administrative headache of having additional service providers is worth it, we'll see clients do passive in large cap core and then active in kind of a satellite value growth, maybe a little more niche, maybe not quite as niche as you're talking about, Trevor, but to add, where areas where we think those insightful managers would be able to add value in an active space in large cap, despite the efficiency. But that said, we have clients all along the spectrum. We have a couple that are fully active, that truly believe in active management. And I would say both staff and investment committee members are big believers in active management. And we have some that are fully passive. Again, those fully passive approaches, I would say, are driven kind of by two different factors. One would be that simplification that I talked about earlier. That return-seeking portion is a much smaller component, maybe somewhere between 10 and 20% of the overall total plan assets. And so having a bunch of complexity in a very small portion of the portfolio doesn't feel worth it in some respects. And the other is that we have some clients with investment committees who are very adamantly non-believers in active management. And if you have a committee that doesn't believe in active management, it's going to be a really hard uphill quarterly meeting cadence where, regardless of what's going on, they are likely to be unhappy with some portion of the portfolio. And so we do a lot of beliefs exercises with committees, trying to get them to articulate that, and then to make sure that whatever kind of equity structure is put in place is reflective of those beliefs. The other thing I should have probably said at the outset that I didn't is that Russell really believes in a multi-manager structure. I think probably we're all talking about a multi-manager structure, but you can blend together pretty elegantly both passive and active in a way that allows for some potential excess returns, but doesn't swamp risk budgets at the same time, or fee budgets.
Aswath?
Can I add? Yeah. I'm going to add on what Trevor and Rachel just said about niche markets, but I'm going to give it a different twist. When you asked me how I reconcile the fact that I think that the market is mostly efficient with the fact that I value companies. My students come to me because they all have to pick a company. Each has to pick a company to value, and they can pick whichever company they want. And they come to me with the question of, hey, what kind of company should I pick? And I give them all the same advice. Go where it's darkest. Go where the uncertainty is greatest, because that's where you're going to find market mistakes, because people tend to flee in herds, whether it's a geography, a sector, a group of companies. I mean, right now, the entertainment sector is broken. It's broken in the sense people have no idea how it's going to come back together again. You look at the Disney, the Warners, the Netflixes, nobody's quite sure. Those are the places I go to value companies because, I mean, if I have to describe a niche, it's that I enjoy uncertainty. I enjoy dealing with uncertainty. I enjoy trying to make estimates in the face of uncertainty. And I know most people don't. So if you're looking for a segment where active investing is going to pay off, it's going to be in segments where there is the most uncertainty. Sometimes it's in small sectors, sometimes it can even be in large companies. You know, if enough uncertainty revolves around AI and Nvidia drops by 40%, it might be time for me to revisit Nvidia and think about, hey, is it undervalued now? So I think uncertainty becomes this key divider in whether you want to go passive or active. The more uncertainty there is, the greater the chance that you might find something that is truly misvalued. But you'll have to live with that gut, with that feeling in your gut after you've taken that position. And I'm not sure very many investment committees want to live with that. So it might not be something that an institutional investor can do, but it's something I can do as an individual investor.
Mhm, mhm. Let's talk about the notion of tactical allocation between active and passive. Let's assume that you're each responsible for a fund that is typically 50% passive, 50% active. Would there be insights you would have into the current market position, dynamics, economics, that would suggest you should be higher or lower with your passive or active exposure? Let's start with Aswath.
I think that's a market timing judgment. And I start with skepticism on that because I'm not a good market timer. So if you ask me, would I do it? I would not. But I concede that there are people out there who might be much better at market timing than I am. But you have to be honest. That is basically what it boils down to. If you're a market timer, you're going to steer away from passive investing now, saying, look, I think the market's too high. Therefore, I need to get away from these big companies that have gone up the most. So I think if you want to make a market timing judgment, I think that might be a tactic you can use. But I would say be honest with yourself. If it's not working at some point in time, you got to stop trying to finesse this. Because unless there's a payoff to doing it, why add that layer of choice to what you're already doing?
I think I would agree. It does feel market timing-ish. It is not something that our clients do or that we would advise our clients to do. Part of that is because of kind of the investment committee cadence that really oversees the client work that we do. Committees typically meet 4 times a year. Really hard to jump in and say, my goodness, with this current market dislocation, we can move right now and shift that allocation more or less toward passive. Committees don't work that quickly. And so that would make it hard. But just from a philosophy standpoint, we tend to like an asset allocation that you stick with for the long term. And I think you can have opinions about the market. It's really hard to articulate those in a way that makes sense. And then to Ashwath's point, how are you measuring that decision that you've made? So again, working with investment committees, if you are taking a tilt or making a bet, they're going to want to be able to demonstrate that that worked or didn't work. And so are you adjusting your benchmark every time you do that so that you have some mechanism to measure your efficacy in those choices?
Trevor, any thoughts?
So I'm gonna have a different answer, but there are some subtle points to it. That are going to seem counterintuitive at first. Even though it's not what we've done at TIFF, I might be open to shifting the active versus passive weight over time. But I share Aswath's skepticism about market timing. So my reason for doing it actually has nothing to do with capital markets. It has to do with the current assessment of the quality of the active manager options. So if I felt really good about the active partners, I might lean a little bit more toward active. And this is also going to be a bit counterintuitive because of my orientation and the way that we run the portfolios, but I'm very, very skeptical of active management. Like for us to take active risk, it's got to be someone special, in our opinion. And finding special investors is really hard. So just to kind of like put into context, we actually rank our active managers every year based on a variety of characteristics that we think are indicative of future investment success. And if you took that weighted average rank, and by the way, I have these numbers, we do look at them here. The rank is not the same every year. And so, if that ranks at the high end of the range, maybe it's worth taking more active risk. But that's got nothing to do with the capital markets. And it's not, in my opinion, like my response to this is not about market timing at all.
Can I add something to Trevor's point, which I think is a very important one, because the existential threat that active investing faces is that long-term trend line is against active investing. I mean, the statistic is not even no argument against it.
Yeah.
You look at 20 years ago versus today, there are far more investment committees today that are resistant to active investing because they've seen what active investing has done to them in the worst possible way. You also see more people shifting into passive investing. So that long-term trend line is a reflection of a loss of faith in active investing, not among academics, not among efficient marketers, but among those people who started as true believers in active investing. That's a trend line that's not going away. In fact, I think if you look at what the end game will look like, I don't think it's going to be 0% active investing. But I will wager it's going to be a lot less active investing than you see today collectively, because that's where we're moving. And that trend line is almost, you can't even really fight it.
I don't think any of us on this call are defending active management as an industry. I mean, Trevor's looking very
But the trend
specifically
lines
at managers.
are about the entire industry, right? It's not about the best active investors.
Right.
And let's face it, the average active investor is crappy. I hate to use that word, but it's crappy, right? You charge me, 100 basis points for delivering 2% less than an index fund. It's going to catch up with you. So I'm not, tarring the entire group, but I'm saying collectively that group is going to get smaller, and maybe the best I think will survive, but it's going to be a far smaller group than what you see out there today.
Yeah. Let's say I was an investment committee member, and Aswath, you're my consultant, and then I'll turn it over to Rachel. And we were making a decision to index more right now. We were kind of giving up the fight because it's been a long battle for active management. And my points were, well, valuations are high, so I'd like more selectivity. And the index is incredibly concentrated. So I think passive is scary right now, just like it was in 89 when
Right.
Japan was by far the largest component of the index, or 99 when tech was by far the largest component of the US. What would your response be to an investment committee member that was making those points?
I'd say I think that's a legitimate point. I am, like everybody else, you worry about the concentration in the index and how much we owe the returns to the top 20 companies carrying us. It's the same 20 companies. That's always been true, that the top 20 companies carry the equity markets. But what's different about the last 2 decades is the same companies every year seem to carry the market. So I'd say if you want to go in active investing, I'd have 2 rules. One is, find active investors who have a philosophy that is consistent. They don't go with the wind, because otherwise you're going to get active investors who tell you they're playing one game, but the next thing you know, when you look at their portfolios, they're buying NVIDIA like everybody else because that's where the returns are. I mean, you want people who have a core philosophy that drives how they do, rather than show you, hey, look how well we did last quarter and look at what we bought. So I'd look for consistency and I'd look for humility, which is I don't divide money into smart money and stupid money. I divide into arrogant money and humble money. I don't want arrogant money, running my portfolio. Now, I am sick and tired of hedge fund managers who come and say, I can conquer the world. I can make 5% more than the market. I'm out of that room before they even finish the pitch. I want humble money. My managers who accept that beating the market is hard, and that they have a core philosophy that they're going to try to adhere to try to deliver those returns. I think those are the kind of active investors that Trevor is looking for. And I think being able to ask the right questions to find out who those managers are becomes a key part of making sure you're succeeding with your active investors.
Yeah, as a consultant, I would say, Russell has a very long history of doing really rigorous manager research. We have an incredible database that dates back decades where we can go and look, and the great thing is with technology improvements over the last decade or so, now we don't just have to take managers' words for it. Like they say, we have this philosophy, we stick to it, we always stick to it. You know, we've got this pond we're fishing in, and that's our only pond. We can take holdings-based data, run it through these great new tools that we have, and prove it out. Like, are they really doing what they're saying they're doing? And I would agree, Aswath, we want people that stick to their knitting. When we are building a diversified portfolio, we're looking for managers to play specific roles in that portfolio. If you have a manager that you hired for one thing that's suddenly doing something else, chasing the next NVIDIA, like you suddenly have a diversification problem. So when our manager research group is going out there and doing this rigorous research, they're looking at the individuals, the people. We don't have a stated philosophy about demeanor like you do, but certainly a humble manager is always better. But the people, the consistency of their process, and that overall kind of driving philosophy that's driving their portfolio. For us, performance is a check on those things. We aren't screening by performance. We're not looking at performance, but we are looking at their investment philosophy and figuring out what are the markets where we would expect this type of process to do well, and those markets where we would expect it to not do well. And then again, using that data to check that. Is that real? Has that played out? And do we understand? Like, it's okay if an active manager underperforms in a market that you know is going to be a headwind to whatever their process is. Like, that's expected. But you've got to have that context of expectation when you're doing the evaluation of any active manager.
You know, it's funny. One of the markers that we look for, actually, there are two that are relevant to some of these comments, but it might be interesting for the audience. For someone who has more of a specialist profile, like they're a tech specialist or they're a country specialist, something that we often look for about timing our entry is absolutely abysmal trailing performance relative to our main benchmark, because that often means that that part of the world is deeply out of favor. The uncertainty factor about outcomes is very high relative to history, and it's often a great time to add. But that only works if the people that we hire are consistent. And so it's funny, we also look for this. One of the characteristics we seek, especially as someone who has kind of an off benchmark, high tracking error strategy, is that they have to have an almost like religious belief in what they're doing, because the reason it's so important is that the temptation to change will be the absolute highest at the worst possible time to change. And so it's funny, we actually, like, when performance is terrible, that often gets our attention, because if the process isn't broken and it just turns out that the holdings are very out of favor, sometimes that's a great time to start.
Mm-hmm. It can be a hard sell to an investment committee, but if you've got
Oh,
the committee with the right mindset, yeah, it's buy low. It's the basic tenet of buy low.
yeah, in my experience, the better the investment is, the less likely it is that a third-party investment committee will approve it. No, seriously, like that's one of the great things about TIFF is that we have full discretion.
Mm-hmm.
And so it makes it a little easier to do things like that.
Trevor, given that you're predominantly active, I mean, I read lots of quarterly letters from equity managers, and there's a general vibe in the letter that if you underperformed, you were wrong. If you matched the market, you were right, but if you beat it, you were even more right. How do you think of benchmarks? Why do they matter?
They matter because at some point, we all have to be measured against something. Like it's only fair, and they matter because clients care about them. And I don't mean for that to sound dismissive. It's a very reasonable thing to do. And they matter for us because, number one, we want to stay in business. But if you think about the mission, for example, of TIFF, the mission of TIFF is to enhance the long-term returns of U.S. nonprofit organizations. And I'm reminded of something that our former CEO used to say to me, back when I was younger and I knew everything. And I wish I had listened to him more closely at the time. He basically would say to me, if we discover the cure for cancer, but nobody takes the medicine, we haven't cured cancer. And the reason I bring it up in the context of this question is, we could have the best investment engine in the world. I'm not saying we do, but we could. But if people don't stick with us through the rough periods, then we're not doing anybody any good.
Yeah.
And so that's why the benchmark, it does matter, and we have to be conscious of it. Now, I think we have to have some courage and deviate. If we're going to have different returns, we have to have a different portfolio. But we need to do it in a thoughtful way, and we need to be aware of just how much risk we're taking and how much is realistic for us to assume that our clients can tolerate.
Good. We're going to switch topics now. When I look at institutional portfolios, many of them continue to be structured with the equity segment on a style box mindset. 9 different style boxes, 12 different style boxes. My question is, do these still have relevance? Are they an antiquated thing that's kind of relegated to the retail world now? Is there a better way to structure rather than style boxes? Rachel?
Yeah, certainly our client base is not style box focused. I think I mentioned previously when we're thinking about a diversified portfolio, we do want managers that kind of span the spectrum. So within, let's say, US equity, like the spectrum of large and small and the spectrum of growth and value. That doesn't mean that we're hiring 9 active managers. For one thing, at least with our client base, there's no way they have the appetite to, or the interest in having 9 separate service providers with 9 contracts and 9 portfolios to oversee. It's administratively too burdensome. But what we do want are managers that are going to adequately cover whatever space that they're in. And so yeah, style boxes, I like the simplicity of them. I understand why individual investors can find them intuitively comforting. Like I've got coverage everywhere. I don't actually think in practice that's how many institutions approach the question.
So you're a little bit like the old Einstein quote, keep things as simple as possible, but no simpler. The style box is too simple.
Well, and it's too simple, but for a real institutional investor, I would say it's almost too complex. Nobody that we're working with, for the most part, unless they're giant, wants 9 managers in a simplified portfolio. It's a lot. 9 is a lot. 12 is full.
You want me to go next?
Yeah, please.
Yeah. So I'll say something a little bit controversial. I think for an organization that is genuinely trying to add some value in public equities, not trying to just replicate the benchmark, I actually think the style box approach may be backwards. Like it may actually be wrong, because the scarce resource is a sustainable competitive advantage in the investment process that generates alpha. And that's paramount. There are other considerations that matter, but that's the key one. And our approach to this basically is we're going to prioritize that characteristic. And if we get to a resulting portfolio where the exposures are way off benchmark, we're just going to handle it ourselves. Now, of course, the deviation from the benchmark does impact some of the manager decisions, but like I think this notion of like trying to force an active manager that fits all 9 boxes, it's almost inevitable that I think that it will result in the average quality of the active managers probably being lower. It's like it would be purely coincidental to me that we found someone fantastic in all 9 boxes. We're going to prioritize, of course we get the assumptions wrong sometimes. It's very hard to get it right. We're going to prioritize where we think the excess return is going to come from. And then we'll handle the portfolio construction after that.
Yeah, I've always disliked the term product when you're talking about equity strategies. One of the differentiators for me is there are firms out there that say, hey, we need to cover all of these 9 style boxes. So they end up with an investor that's not doing it from the heart. It's not their heart and soul. It's just creating a product. Aswath, do you have any thoughts on the segmentation topic?
I've always believed it's artificial. I mean, the adding this constraint of, especially with size and value. And I think every time somebody does it, somebody should be paying a royalty to Farmer and French, because, it'd be interesting to see how much style boxes kicked up after the Farmer French article, because in a sense, wasn't that people wanted to get diversified. They wanted to take advantage of the small cap premium or the value premium, and the style boxes actually gave them a kind of, at least a setup to do it. So I've never believed in those constraints. I do believe that sector constraints might make more sense than the traditional style constraints, because we get too much into, if 60% of your money is in technology, I might need to know that. So I do think some constraints matter, but the traditional style box constraints I've never understood, especially if they're imposed in a rigid way. Maybe they're just there for people to get a sense of what their portfolio looks like, in which case I don't have a problem, it's just another picture. But if then they start to say, look, I need managers in this box because we don't have enough money in there, then I think we have what Trevor pointed out, which is you're adding a constraint and adding managers for the simple reason of filling in boxes that don't need to be filled out.
Yeah.
Can I make one additional point? And this is off topic a little bit, but we work with large defined contribution plans as well. And this is one place where I think investor psychology can play a big role, particularly as it pertains to defined contribution participants. And so oftentimes we see that DC plans that offer style box options. So you've got a large growth, you've got a large value, you've got small growth, you've got small value. You see really perverse participant behavior that is return seeking and can result in them having allocations that again, with that long-term lens, are probably not optimal for what's likely to happen within the markets.
Mm-hmm. Mm-hmm. A few of you have talked about selecting active managers. Trevor, you've gone into some detail, but I'm going to ask that you go into a little bit more. When you're looking at managers, is there a menu of criteria that you follow? And Rachel, I'll ask you the exact same question. So basically, we're asking, if you can put it in a nutshell, what your selection criteria is.
Yeah, for us, there are 3. This would be very high level and simple, and I can elaborate with some detail if it's of interest. There are 3 characteristics that are very important to us. But one I've talked about briefly, but this notion of a sustainable competitive advantage in the investments process, that's number 1, and probably is the hardest thing to find. The second item that we prioritize is a proper alignment of interests, and there's an internal element to that and an external element to it. The internal element deals with characteristics like how the organization handles compensation. Like, are people who work there motivated to outperform? Are they likely to be able to attract and retain great people over time? We tend to like firms that are 100% employee owned. There's no outside interference. There's no pressure, for example, from a publicly traded parent for the investment team to take on capital when they don't want to, things like that. The external piece deals mostly with the terms on offer to us. We prefer low management fees and we favor performance fees. We tend to like firms that have a singular focus. They basically have one strategy. That's what they put all of their effort into. We think it's hard to be world-class at anything. It's really hard to be world-class at 5 or 6 or 10 things at the same time. So this notion of alignment is very important to us. And then the last piece, which is actually, it's more about us, less about the manager, but I think it's very important. There has to be, the idea in question has got to deliver strategic value to the rest of the portfolio. And so what I mean by that is we're not really in the business of collecting manager relationships. There's a limited number of positions that I think we can monitor well and really know in great detail. And once we creep over that number, actually, it's funny. I think actually having a very diversified portfolio makes some people feel better. I actually worry about it quite a bit because I think the probability that we're going to miss something starts to go up. And so what I mean by strategic value to the portfolio and this notion of keeping the position count manageable, everything that we add, it's either got to add a diversifying exposure that we want that we don't have. So basically that will lead to good returns, but possibly reduce tracking error and reduce fall. That's of value. But if it's not a diversifying exposure, and what that basically means is it's something we already have in some form. It's got to be an upgrade over the investment we already have in the book. And if it doesn't meet one of those two criteria, it probably doesn't make sense for us to include it. That high level, that's how we
Yeah.
think about it.
Before I go to Rachel, Trevor, I know what your portfolio looks like. You've got some specialist managers, be they China or healthcare or biotech. When you allocate and size those positions, what's the trade-off between thinking about alpha potential, where it's been huge, and the projected beta?
So we think about it in a couple of different ways. Number one, there's the trade-off between expected incremental excess return and incremental tracking error. And this goes back to a comment I made earlier. In my estimation, most of our clients can tolerate a tracking error in their public equity allocation that's active of something like 3%. And we basically manage, roughly speaking, to that metric. That's our guideline, and it's what we've delivered over time. And we're basically trying to maximize IR. And so there's a trade-off between incremental alpha and incremental tracking error. And then the second way that we look at it, this also goes back to a comment I made earlier. We've placed a big emphasis on understanding the positions in the portfolio. We have a pretty good sense. We get this on a weekly basis, and the monthly stats are even more accurate. We have a pretty good sense, for example, of what our look-through exposure is to each sector. And if we're already way overweight, let's say healthcare, and we're contemplating adding a healthcare specialist, we either need to have it be a replacement for something else we already have, or if we really feel confident about it, we have to have a way to cost effectively hedge back the beta. So for example, like we think it's different now, but for a period of time, we were overweight China in our portfolio, roughly 2016 through 2021. We would have been even more overweight based on the alpha opportunity. The problem is hedging it back was cost prohibitive. And so we basically had to, we limited what we probably would have otherwise done just because it wasn't cost effective and we would have blown up our risk budget.
Yeah. Thanks. Rachel, your thoughts on selection criteria?
Yeah, I think I mentioned previously. So we call our approach, it's the 4 Ps. So it's people, who are the underlying portfolio managers and analysts? Is it like a star portfolio manager approach? Is it a co-portfolio manager approach? We're fine with either. We just really want to understand who's driving decisions and how they're accountable for those decisions as well. Process. So again, trying to look for somebody who has a unique investment philosophy and a repeatable process that we think long-term will work. Verifying all of that by looking at the portfolio. Are they doing what they say they're going to do? And then does that pan out through the performance, which is the 4th P? Really, we're looking for what we would call skillful risk takers. Skill is hard to identify, takes a lot of work, takes a lot of history and a lot of knowledge. You know, we have at Russell career analysts that spend their entire careers typically in a single asset class, researching managers. Some of these managers they've known for decades through the life cycle of their own firm. Trevor, you mentioned something early on about liking early life cycle managers. Early life cycle is great if you can get an investment committee on board, getting in early, particularly with something like a small cap manager where hopefully they have a cap on the number of assets that they will take in, can be really impactful in terms of the ultimate performance that you get. We have a continuous research process. So we see any manager or product that is funded by either a Russell fund from the other side of the house or through a Russell consulting client. They get seen at least annually. go in and do kind of the kick the tires. Have there been changes? And again, are their holdings bearing out that investment philosophy that they're holding up? Historically, I would say we probably had clients that used more niche managers 10 years ago than now. And again, a lot of that has to do with kind of that simplification that a lot of these corporate clients have gone through. When you have a limited number of managers, it's hard to have a lot of really niche approaches. We also found that, again, with that kind of headline risk or regret risk, the more concentrated portfolios sometimes get more scrutiny from an investment committee, and they may not have the staying power that might be needed for a super niche approach. Again, that's probably just specific to the types of clients that we're working with most often. But a disciplined process of reviewing investment approaches, making sure that managers are doing what they're saying they're doing, and then putting them together in a thoughtful way. Again, I feel really lucky at Russell Investments because we have some really great tech tools that allow us to do modeling of different manager portfolios. So, Trevor, you were talking about making a manager change. So, if we have a manager, our manager research group ranks managers 1 through 4. 4 would be our highest rating. If there's been a downgrade in a manager and a client is considering a change, certainly you want to make sure that that change is going to be worth the cost of the change. Switching managers is not costless. And so whatever alpha pickup needs to compensate for the cost of that trade. But we can also use these great tech tools to go in and kind of model out different portfolios and see at a holdings level, okay, if we swapped out manager A for manager B, what would that resulting portfolio look like historically, and what would we expect it to look like in the future? Is it giving us the exposures that we want? And tracking error is always an issue as well. We don't have a hard and fast rule, and tracking error appetites, I would say, vary by client, but certainly you don't want a super high tracking error product with a sensitive investment committee. It's going to be really hard to stay the course.
Yeah. Aswath, you're an active manager skeptic, but you've also said you would look at managers or investors who embrace areas of uncertainty. Would there be any other criteria that would be at the top of your list?
I mean, luckily for me, I don't spend as much time with money managers as Trevor and Rachel. I probably speak more to my Starbucks barista than I do. But I'll go back to basics, right? A money manager walks in and wants me to invest with them. My first question is, what is the market mistake that you think you can exploit? Because the essence of active investing is that there is a market mistake that you think you can exploit. And second, why do you think you're better positioned than others to take advantage of the mistake? Trevor mentioned biotech. There, the market mistake might be that biotech is a really tough sector for the market to gauge success and failure because you have drugs working their way through the pipeline. You have no idea how. So your answer might be in that sector, markets don't do a very good job. And what I can bring to the table is I have people who are immersed in this process. I've hired doctors and scientists who can gauge these drugs, and I'm willing to listen now. I'm less inclined to look at a historical track record than getting an understanding of, do you know the market mistake you're going after? And do you have a sense of why you're better positioned than other people do? Because if you have those pieces in place, then I have more faith in you as an active investor than if you say, look, I think markets make mistakes with small companies. Why? I mean, that's why the size effect to me was always such an empty rationale for investing. What is it about small companies that makes it more likely that markets make mistakes? So unless you can think through that market mistake aspect, I am skeptical about whatever track record you show me, about whether it's a statistical noise that I'm capturing there or something really bringing to the table. So I think that market mistake and correction part of it is a big part of an investment philosophy. And those active investors who have thought through that part of the process more, I'm more inclined to trust.
When you talk about market mistakes, do you prefer to hear an answer from a manager that it's something systematic that persists? Or could they simply say,
And then I'd have a follow-up. Why does it persist, right? Because unless you can give me a reason that because the nature of mistakes is people find them and they disappear. That's how markets become efficient in the first place.
Yeah.
So when something persists, it's less likely to be a market mistake and more likely to be a reflection of something fundamental going on. And I want you to think about what that is, because when that fundamental shifts, then the market mistake is going to go away. As you know, I've been a skeptic about the small cap premium for a long time. There hasn't been one since 1979. Now, if you start the timeline, starting in 1979, there's been no small cap premium. But I think that the reason for that is fundamental. The things that gave rise to the small cap premium have weakened or dissipated or even disappeared, which is the reason the small cap premium has gone away. So when people hold on to the small cap, it's coming back. I'm not sure they understand what's coming back because they've not thought through what causes small cap companies to earn a higher return than large cap companies.
I get that, but I think it's even worse than you described because the study on small cap goes back to 1926, and they use the bottom decile of the New York Stock Exchange, which were mainly fallen angels as opposed to small, innovative types of companies. We are on the topic of differentiating between managers, what manager selection criteria is. I think it's worth pointing out that value has dramatically underperformed growth or even core over the last 10 to 12 years. Aswath, in our discussions, you brought up something very interesting. You differentiate value managers, and there's something you call lazy value. Can you explain that to our audience?
I mean, for 40 years now, we've treated low price to book stocks as value stocks. That again comes out of an academic. I mean, academics are lazy. They have to classify thousands of companies. They want to use a metric that they can easily get. Price to book was the metric. That was the original value premium in the Farmer French. It's a price to book premium. It's not a value premium. We've called it a value premium. So somehow over time, people think if they buy low price to book stocks, and I blame the Ben Graham security analysis strand feeding into it as well, that somehow they bought value stocks. And if they buy a high price earnings or a high price to book stock, they bought a growth stock. Well, if that's what you're doing, then why do I need an active investor? An ETF can buy low price to book stocks just as well as you can, probably not screw up along the way because it doesn't make math errors. So I think if we want to talk about value versus growth, we've got to talk about the full essence of value. To me, NVIDIA was undervalued in 2018. It wasn't a low price to book stock. It was undervalued because given its growth and cash flow potential, it was trading at a low price. I think we need to open the door to value being something that reflects price versus what the cash flows in this business will generate as value. That's a much richer definition of value than this sloppy low price to book as value and high price to book as growth. Because that really, to me, is not value versus growth. It's just low price to book versus high price to book.
Yeah, it's funny. If you look at our portfolios, the manager that consistently has the most statistically expensive portfolio in our roster insists that he is a value manager for largely similar reasons.
Well, I have a particular affinity to the argument you just made. Value managers differ in significant ways. On this topic, I've got two more questions. And this one probably goes to Rachel and Trevor. How can you tell? Is it possible to tell when a manager that's had a winning strategy is about to sour? Are there any indicators you can point to?
So I would argue if they have a repeatable investment process, it's not that their process is going to sour, it's that the market will not be rewarding what they're going after through no fault of their own. So again, wanting managers that stick to their knitting. Performance is cyclical. We don't expect every manager to outperform all the time. So I think the caution I would have is if you have an investment manager and they've been doing really well, but they're changing their process, hoping to chase what's going to work next, that's a manager we don't want. I know that's not really an answer to your question, but we advise all of our clients and committees to try to have patience with investment philosophies that are out of style. And that can be hard, and the timeline on that can be particularly challenging. But if there's a true information advantage or a true anomaly that is being exploited in the market, then over time, that should be rewarded, and you don't want to walk away from the manager at exactly the wrong time.
Yeah. Let me see if I can phrase this a little differently. What would be, if you can generalize the reasons that Russell would take a top-rated manager, I think at number 4,
Yep.
down to a lower rated or terminate manager?
Sure. There's a couple different drivers there. The one big one that we see often is if it is kind of a star portfolio manager model. There's one portfolio manager, they are the final decision maker, they are constructing that portfolio, and they leave. Then the question is, was there a succession plan in place, and do we have as much confidence in whomever the successor is than we had in that star PM? Kind of general organizational turmoil can play a role in a manager's ranking, making sure that whatever the product is sufficiently important enough to the organization that they are getting the resources that they need in terms of tech or analyst support, can be an important driver. So those are kind of non-investment reasons that a ranking might change. And then in terms of like real philosophy-driven rank changes, that would be somebody who has a stated investment philosophy and for whatever reason doesn't stick to it.
Yeah.
That
Trevor?
would drive a downgrade.
Thanks, Rachel. Trevor?
Yeah, so I'm gonna break this into two pieces. There's one answer for when it's time to rebalance and to take take some risk off and redeploy capital somewhere else. And there's a different set of answers for when it's time to terminate a relationship, basically. The keys that I look for on rebalancing are trailing excess return that's greater than like a standard deviation and a half ahead of our expectations. Valuations in that area are very high, and there's what I would loosely categorize as like hot money coming in, either into the manager or into that part of the market more broadly. Like those are markers for when it's probably time to rebalance a bit. And by the way, when those sets of characteristics are in place, generally the outperformance of that strategy is such that it's probably too big relative to our portfolio construction strategy anyway. And so I think this just like this kind of tends to happen on its own if we're careful about portfolio hygiene. But these are markers of areas where you probably don't want to be overextended on risk. On a full redemption, a lot of it touches on what Rachel said. So I'll be very brief about it. There are basically 3 reasons why we end a relationship. One is a set of what I'll call material adverse changes. So launching too many strategies, too many assets are coming in, someone important departs, and we just don't think it's easy to replace that person, things like that. The second one is we made a mistake. We messed up. Like we thought there was a competitive advantage in what this team was doing. And the truth is, upon further review and with more information, we were probably wrong about it. And we have to face the music and admit it. And then the third one has nothing to do with the manager. They did nothing wrong. It's just we found an upgrade. We just found somebody better.
Great. So the last question for this topic has to do with quant managers. I'm after somebody to define what a quant manager is relative to what we might call a fundamental or more qualitative manager. And baked into the question is AI. We've all heard about it. What do you think the impact of AI will be on investing? Whoever would like to go first.
I'll jump in. I mean, I think, I wrote a piece called Beat Your Bot. Basically, I talked about the areas where AI is going to succeed. If your investment philosophy is mechanical and rule-driven, AI will beat you to it. So I think it's a very simple, it's just the fact the machine is better at mechanical stuff than you and I will ever be. And that's, I think, part of the reason, active investing is going to shrink over time. So much of active investing, I'm talking about the general population, is mechanical. You look at what people do and say, you need 100 people. You walk into a building, there are 500 people working in the building, and they're all screening S&P Capital IQ for low PE ratios. Why the heck do I need 500 people to do it? So to begin with, any mechanical rule-based strategy where almost everything that you're doing comes from mechanical approaches, AI is going to beat you to it. There's going to be an ETF that does it with one person running it, and they're going to be able to do what you do. So I think that it goes back to what makes successful managers successful is you're bringing something to the table that's not mechanical. It's consistent, but it's not mechanical. Now, adding though to the previous point about, philosophies, if a philosophy is personality driven rather than driven by something structural, you have to worry about two other things. One is age, and the other is the God complex. The age, of course, is, everybody gets older. I mean, this is not so much to do with active investing, but I've tracked Berkshire Hathaway through its entire history. In 1999, Berkshire Hathaway traded at a price to book ratio, and I'm going to go to a very simple metric, just twice that of a typical insurance company, because it was an insurance company with a closed-end mutual fund run by the best known active investor of all time. That's disappeared. You can think whatever you want about Wexler and Combs, but they're not going to be able to replicate what Buffett brought to the table because times have changed and they're not Warren Buffett. So I think that AI is going to be a threat to any mechanical rule-based strategy, and that might be a good thing.
You, Rachel?
Yeah, I think I would have a slightly different take on it. I would say the institutional quantitative managers that we work with have been ones who have harnessed AI from the beginning. And I guess the differentiator there is these quantitative managers try to find some unique element that they are going to exploit. A lot of them are very secretive about what those elements are. They will only tell you retrospectively, what these different factors or key things that they were looking for are in portfolios. Certainly, could they probably in the future need less people? Yeah, but I don't think they go away. I would flip it a little bit and say internally within Russell, we've actually started using AI at the front end of our manager research process just to allow us to get exposure to a broader set of products, right? We have a finite number of people, individual people going in and pulling all the data down and looking at all the characteristics. That takes a long time. AI can do it super fast. So not impacting the number of people that we have doing research, but allowing us to get a broader set of products to look at, to evaluate. I think AI is really interesting. I have a youngish son, and I think about, actually I have two of them, and think about them entering the workforce. I do think it's going to be a super impactful change. But I do think that there are benefits that could come in certain areas, but we'll all have to be adaptive to what that means long-term in terms of the workforce.
Trevor?
Our view of this is that AI very likely benefits the systematic managers because, and I think it's actually a real threat to the fundamental folks because it's more possible than ever before that elements of what they do can be automated. And so the reason why we think it benefits the systematic community is because they're just naturally better positioned to make use of this. They are used to rules-based processes. That's the core of their main business anyway. They have typically a lot of programmers on staff already. And so we basically think that this is going to help sophisticated systematic firms. And as a result, in our own portfolios, we've actually shifted capital over the last roughly 12 months from fundamental to systematic. We still use both, but we want to be on the right side of this trend, basically.
Good.
Over the long run, AI is potentially a threat to the entire complex, but I think that's going to take more time.
Yeah.
You think it'll be harder for the active management world to beat indices based on AI, or?
I do. I think it's part of the natural trend that Aswath brought up earlier, which is over time, things that used to be alpha become beta. They become commoditized and generally speaking, available at lower cost. And we've seen versions of that in the capital markets for years and years and years. And this is another iteration of it.
That's a concept that my old friend Steve Luthold used to use a lot. He would say with recognition brings ruin, which I think holds true here. Let's switch to our last topic. And I guess I'd preface it by saying this somewhat unique market where the indices have been very, very hard to beat. Some of those key tenets I talked about at the outset haven't worked at all. And this goes much more than a 3-year cycle. It's 10 and even 16. And I ask myself, as an active manager believer, where am I wrong? And two things have come up. One is that this market seems much more mechanistically driven. 80% of trades are systematic, whether it's risk parity or people dumping money on a monthly basis into defined contribution plans. And there's no regard for valuation in these trades. So does that change the way we look at active management? And secondly, a very interesting concept that actually Aswath brought to me, which is the world has changed. It's become more of a winner-take-all environment. There's always going to be 10 companies or so. They may be different from decade to decade, but they're always going to be different. So how important are these 2 points in terms of how we think about the active versus passive call? Aswath, I'll have you start. Maybe describe a little bit more about the winner-take-all world.
I'll do it quickly because Rachel, as I said, 9:30 is our breaking point. So I want to finish by then. I do think that that passive investing in general, and that's part of the mechanistic drive, is increasing the power of momentum in both directions. I mean, right now we notice the upside, but we're feeling that we will see the downside as well. So momentum has become an even stronger force than it used to be. Second, I think the structural shift of especially how technology platforms have changed what used to be splintered businesses into winner-take-all businesses is still playing out. I mean, ride sharing 20 years ago was hopelessly splintered. Then came along, because cab companies essentially around the world. Advertising, hopelessly splintered, now concentrated. And I think that structural shift is not going away. And as Trevor pointed out, AI is going to make the strong even stronger. So it's going to make the biggest players even bigger in pretty much every dimension. And I think that is going to show up not just in the economy and what we think about antitrust, but in markets in terms of where the money is going to be made. Is what we've seen for the last 15 years might be the reality we face for a stretch in the future.
Trevor, any comments here? Yeah, I hate to be boring, but I agree with the general observation about the big getting bigger. Because if you think about the transformations that Aswath just walked through, like the consolidation in ride sharing, advertising, all of that has been tech enabled, basically. And I think what's happening is that the pace of technological innovation is accelerating, and tech is impacting every single industry in some way. And AI is a very obvious version of that, but there are others. And the larger businesses, I think, are better. This is sort of like my comment earlier about systematic managers, but it's about the economy more broadly. Larger businesses are better equipped, I think, to take advantage of technological innovations, because some of these things require hefty fixed costs, and the big businesses can absorb them more easily. Some of these innovations are really maximized on value when there's a lot of data to use in the new system, and the big businesses have lots of data. And so I do think that tech innovation probably causes the big companies to continue to be bigger. And by the way, like people talk about the Mag 7 and how amazing their stock performance has been over the last 3 to 5 years. A big part of the reason for it is because this is not like 1999. these businesses are actually generating outstanding fundamental performance. And I
Right.
think part of the reason for it is this dynamic. Like these big tech companies can really make use of technological innovation in a cost-effective way that a like $2 billion small cap, I just think they're going to struggle to do it.
Mhm. Yeah, I agree with both sets of comments there. The only thing that always is in the back of my mind is, I think something I said at the beginning, which is like every time people decide that things are fundamentally different is when we seem to have a shift in another direction. And so I think getting into that fixed mindset that markets are always going to present in the way that they are currently presenting, and it's always going to be those whatever 7, 10 big tech companies that are the drivers, and small cap is never going to work again, and value is never going to work again. Seems like that's when the shift happens and we all get
Yeah.
humbled a little bit.
Oh, I want to be clear. I don't think value's dead.
Yeah.
I think it's just been dormant for a very long time. And
Yeah.
part of the this is also an opinion. Part of the reason for it, I think, is that people care about valuations a lot more in a tough market.
Hmm.
We saw a little wrinkle of that in
Yep.
2022,
Yep.
but it didn't last that long, and so it's
Yep.
easy to kind of forget about it. But I don't think we've been through a really tough equity environment for a very long time. Like
Yeah.
I personally count COVID. It was scary, but it was short-lived.
Yeah.
And the GFC was very scary, especially for financial companies, but that was also pretty short-lived. Like we haven't been through a protracted, nasty environment really since probably 2000 to 02 is the last time, this went on for years and it was not great.
Yeah.
So, one final point on that I wanted to add is that I don't think there's a large cap premium now. I don't think there's a growth premium now. I think what we're going to return to is a world where some years small caps are going to win some, which I think is actually a much healthier world than the one we saw in the last century, where you saw, low price to book and small cap have extended periods. I think we're just going to get through a more normal cycle. And the market is going to adjust far quicker than the economy is, which is the economy might continue to be winner take all, but at some point the market's going to incorporate that and then overshoot. So that's going to have, so what happens in the economy and what happens in investing will diverge at that point in time.
Terrific. I think we're coming up against our time frame. Maybe we have another session, and I would begin by asking Aswath, God forbid you woke up tomorrow as the CIO at a $20 billion endowment or a $10 billion endowment, how would you approach it? But that's for a later date. Thank you so much to our panelists. I want to also thank the Brandis Center within the Rady School of Management. And my hope is that members of our audience have been able to take certain nuggets of the concepts we've discussed to help you in your decision making. Thanks so much.
Thank you.
Thank
Yeah.
you.